Danger signals for your trading. Good morning, everybody, and welcome to today's Morning Coffee with Mike. Today, we are talking about using danger signals to exit trades. This actually came in from the Trading Mind Wheel virtual conference. We're getting towards the end of the questions that came in from the conference, and someone had asked about in time-bound stops to exit trades. I used to use time-bound stops, and in a way, danger signals can act as time-bound stops. It's actually a concept that I discuss in my book, The Trading Mind Wheel, which I have posted down below on Instagram and also on all these other platforms: Facebook, LinkedIn, Twitter, YouTube. So the idea of danger signals as a time-bound stop. Danger signals, if we're going to measure danger signals, we're measuring the weight of evidence against a trade. Now, well, what does that mean? It means that if we get certain danger signals, that we're not going to immediately act. What we're going to do is wait for there to be a certain number, a certain tipping point to cause us to exit the trade. Personally, I found this to be much better than using a simple, say, ATR or a trailing stop or even a moving average. And the reason why is because when any one of those things are violated, it can be just one violation. It might just be one danger signal, and price might end up rebounding by the end of the day and be completely fine. Yeah, have you ever noticed that? Have you ever noticed where on a certain day you'll see price action and you'll get something that is a both a buy signal and a sell signal? Yeah, I have too, and I found that to be incredibly frustrating, especially when I'm trying to manage trades in real time. So I came up with this idea of having danger signals, measuring the weight of evidence against a trade, and it's been so much easier. It's been not only has it helped me to manage trades better, but it's also taken a lot of the stress out of trading. And part of it is because of that very reason where if you are looking at a trade and you're seeing signals in both directions for buying and for selling, then it helps us to have something that's nice and clear and cut. In fact, I'd like to share with you a couple of examples. I'm going to share with you example of a couple of trades that I'm in right now that I've shared in my newsletter and want to walk you through a few of these here. So let's get this going. Okay, so the first trade up is Mobileye. Mobileye ticker MBLY. In fact, I'm in this one now. I got in right over here at 43.60. It had gapped up on the day to start the morning off. And just a little tidbit, a little side note, something that might be able to help you. When you place an order and stock gaps up, I like to step my orders and step away. So what I'll do is I'll set a buy stop limit order at the price that I want to get in. So in this case, I wanted to get in at 43.60. And so I set my buy stop at 43.60, but I set the limit part of the order 1% above that entry price. And I always like to do 1%, or generally speaking, I like to do 1% because it gives me enough of a buffer to get in without price running away, and it's also enough for me to not get uh, filled at a price that's far higher than my initial risk and something that would cause me to take on far greater risk than I had intended. So that's why I like to set buy stop limit orders. Now, as far as the danger signals of this trade go, and how do I use danger signals and things of that nature? So far, when I entered this trade and I'm checking each day by day, to see how many danger signals I have, If I get to certain danger signals at certain points in the trade, I'll look to exit. I'll share a few of the danger signals that I follow with you. Let me bring this spreadsheet over here. Let me know if you're able to see this okay. I'll make this a little bit bigger. Okay, so these are the danger signals that I'm looking at. You can see that there's a whole bunch of danger signals that I look for every day. And I actually had these danger signals broken up in a couple of different ways. And I've reproduced these spreadsheets in the Trading Mind Wheel book. But to share them with you here, I have certain danger signals that I look for throughout the trade. I have certain danger signals that I'm looking at during the open, what I consider the open game, certain danger signals during the mid game and the end game, and certain danger signals that are strictly for the end game. Now, the reason why I've broken it up in this way is because when I go back and look at my closed trades, all the closed trades that I have, I keep those in a journal as well. What I found was that at different parts of the trade, the more danger signals matter than at other parts of the trade. So at the very beginning of the trade, I should exit immediately if there's a certain number of danger signals. And the number that I found, bring it back up here. Hopefully you guys can see this, is 6 or more. So I'll exit based on danger signals if I have 6 or more danger signals at the very beginning of the trade. When when we first get into trades, our best trades will often work immediately, or at least that's what I've found. When you're trying to figure out what's going to work best for you, you should always go back and test anything that you hear from me, anything that you hear from anybody else over your own data set to see how it's going to work for you. So, as far as these danger signals go, when I get 6 or more in the beginning of the trade, that's it. I'm calling it quits. When I get into the middle of the trade, then I bump it up to 7 and the rules change a little bit. What the rule changes to is that if I get 7 or more, then I'm going to aggressively raise my stop. Part of the reason why is because when I'm in the middle of the trade, my objective is also different. We have different objectives at different parts of the trade. And in the beginning of the trade, the objective is get risk off the table as soon as possible. Think about each trade that you place as merchandise that you're buying, right? Like if you were running a business, if you're running a store, it's merchandise that you're buying. So you buy the merchandise, it's in your store. When you get the risk off the table, it's like you made a profit on that merchandise, right? So let's say that you bought some shoes, you're selling shoes. You paid money for the shoes, and now that money's back in, and you're able to recycle it to something else. That's the same thing with getting your stock to break even. So in the beginning part of the trade, I consider that to be getting my stuff to break even. And if I start to see more danger signals picking up in the beginning of the trade, then that's telling me that this trade probably isn't going to be a winner. Let me just cut the loss and leave. In the middle of the trade, my stop has already been raised to break even, so I want to give that a chance to get to my average gain. That's why there's more danger signals involved. And so, what I'll do to give you an example of how this gets used in real time, part of how I manage my stop placement as trades progress. Mobileye is still early in its move, but yeah, IoT has gotten to about my average gain, a little bit beyond 10%. Alpha has been doing fabulous. So Elf, I entered back here on March the 23rd, no, March the 24th, and this has just acted perfectly. It's hard to ask for a better price action than this. So far, it's up about 20%. And Well, what I'll do in this scenario is I'll manage my stop based on how many danger signals it would take to get to that stop area. And so, since this one is in the end part of the game, now I want to give it more room. I allow it 9 danger signals in order to take some kind of immediate action. In this case, I'm leaving my stop way down here. So there's multiple things that would need to happen in order to stop me out. And well, one other thing too, with this whole concept of danger signals and using those to stop you out, and it kind of acts like a time bound stop, is that if you're measuring danger signals and you have things like price closing near a daily low or price closing near a weekly low, in real time, those things might look terrible. Let me move this screen over a little bit so that way you guys on Instagram can see it better too. If you get any one of these, close near the daily low or close near the weekly low, either one of those happening on high relative volume, it might look absolutely terrible and you might be scared and you might want to exit the trade. But that might be the only thing that's wrong with the trade. And if you're measuring danger signals and allowing danger signals to act as your means of exiting the trade, then it'll help give you great perspective because you might look and find, well, there's only 2 or 3 danger signals. This actually is not that bad of a day. Let me stick with this trade. And that's what happened with Elf here, and how I've been able to hold Elf for this longer move. Like in real time, this day on April 5th was a little bit hairy, right? I was at a 10% gain. It came back down at one point in the day. I was down to a 3% gain. Not great, but not that many danger signals on the day, so stuck with it. And now prices way up here at about a 26% gain. So that's it on danger signals. Let me know what questions you guys have, and questions about danger signals, questions about time bound stops, questions about any of this stuff. And while you are getting your questions in, I'll have a sip of coffee. Well, let me know what you guys think of this mug. Not sure if you've seen this one, or maybe you haven't seen this one in a while. This is the monkey mug. Oh yeah. By the way, well, wanted to give a shout out to my friend Francesco, who shouted out the show the other day and told us that we are his running partner every once in a while on the weekends. Thanks for listening, Francesco. Listens on Spotify. So we take these shows and we put them on Spotify and iTunes and all over the place after we record them live. So if you're not already subscribed over on Spotify, go subscribe there. Let's check out some of the questions here. Some people watching at night in over in India. Uh, well, Frindo said today you opened the position. So the trades that we spoke about. So we were talking about Mobileye earlier. I'll bring that chart back up. So each of these trades, right? So that's still ELF. Here was Mobileye. We were talking about that one earlier. Mobileye was started back here on, well, what day was that? That was Tuesday, April 18th. And the reason why I bought this trade, well, went into this, it was first because it passed my screening process. So I have a screening process where I'm looking for extraordinary earnings, extraordinary sales, certain levels of growth rate, certain ROE, and several other factors. Past all that, it earned a spot on my universe list. When I looked for the chart pattern that I like to see, you notice these little yellow lines here? So what this is showing is volatility contracting from left to right. And one of the patterns that I like to trade is that volatility contraction pattern, the VCP. My friend Mark Minervini trades this and wrote an entire book about it. And it's a great pattern. And what it's basically is happening in this pattern is that supply is stopping. There's huge demand for it in the beginning, right? You see the demand, so this is already in an uptrend, and then it consolidates. And so the supply of the people that are happy that wanted to sell way back here, they start selling off, and then they sell off some more, and then they sell off some more, and eventually what happens is that their selling stops, and then there's room for the price to resume the uptrend, and that's what's happening here. So you could see it in the price action, and also importantly down here in the volume. So yeah, I took that trade on Tuesday, and because it has not violated uh, enough danger signals, I'm still in this trade. And right now, this trade is up about 5%, maybe a little bit more from where I bought it. Let's see. Well, what other questions have come in? Scrolling through Instagram here. Is danger signals look like a dead cross? No. No, they're not. So there's many danger signals that I looked for. The death cross is where you typically see the 50-day moving average cross below the 200-day moving average. You might consider that a danger signal. In fact, how I would recommend that you define danger signals is not just based on what I'm saying. What I'm telling you is what works for me. What I would recommend that you do is that whether you're listening to me or listening to anyone else, you see how those signals work for your system. And some will work, some might not work so well. For me, the death cross, the 50-day crossing below the 200-day, is pretty late. And I am generally long gone before that ever occurs. In fact, sometimes it could be a decent place to short if the circumstances are correct. But yes, you can use the death cross as as a danger signal. I don't have it because it's too late, and I would seldom look at that anyway. I will tell you though that when shorter term moving averages cross, that does count as a danger signal for me. For example, in my trading, uh, I am a shorter term swing trader, so my average holding period tends to be about a month. When I see the 5 EMA cross below the 10 EMA, that's something that is a danger signal for me. The reason why you might think that some people might think that that's extremely fast. The reason for me is because my best trades tend to work and go and have a lot of momentum. So if the 5 starts to cross below the 10, that's a sign that it is consolidating in the short term and a loss of momentum. It's one thing that might kick me out of the trade, but if that's the only thing that I'm seeing, or maybe usually there's 2 or 3 other things accompanying it, that's fine. But if I see 7 danger signals, then that's something that would prompt me to take action. Again, all these danger signal concepts are all in the Trading Mind Wheel book. So if you haven't gotten this yet, there's a lot of great information in here. Go check it out. Tradingmindwheel.com. Available pretty much everywhere books are sold. see what other questions do you guys have? Scrolling through, scrolling through. All right, looks like that is it for questions for today. Want to thank you guys so much for joining me today, Monday. I hope that you guys have a great rest of your week. And I'll see you back here again tomorrow, 9:30 a.m. Eastern Standard Time. Take care. Much love. Peace out, everybody.